Welcome everybody to yet another Take Back Control Tuesday. And I want to thank you all for joining us. Now, I can't tell you what the outcome is going to be for each of you, but what I can tell you is what you're about to learn absolutely can change your financial future. If you're here, you're probably ready for change. And what you're going to learn and the insights you're going to take out of this will help you get there. So if the prospect of taking back control of your money isn't enough to keep you glued to this screen right here for the next 90 minutes, then I think we really need to reassess our priorities. And tonight we have an extra special guest, Mr. Carson Herling. And you know, there's an interesting story. I met Carson through his dad. His dad's been a dear friend of mine, and his father was the first person I ever heard on stage say this. He said, the ultimate in real estate is being the bank. And now the legacy passes on, and you're gonna hear from Carson. You're gonna hear about how this has changed his life, but not just his life, his young family's life. So let me just give you a quick overview of what you're gonna learn. There's essentially three basic things you're gonna learn from tonight. Number one, you're gonna learn how to take back control of your money by being the bank. Number two, you're gonna learn how to build wealth through your own debts and expenses, and it's not gonna require you working harder, working longer, or taking on any additional risks. And number three, you're gonna learn how to get all the money back for every single car you will ever buy, drive, and own. If that's not enough to keep you here, well then, you're riding a bicycle home. All right, so that's enough from me. Let's dive in.
Take back control.
Tuesday?
I want to start by bringing up an idea. Have you guys ever thought of owning a bank before or becoming your own bank? Does that ever come across your mind? You ever thought about doing that in your past or hoping to do that in your future? If you guys think about it, if you were to become your own bank, how would you do that? You know, if you owned a bank, would you always make deposits in your bank? Probably, right? Would you go to some other person's bank to do financing? Would you go to Bank of America or Wells Fargo or Chase or JP Morgan? Probably wouldn't. If you had your own bank, you'd stick with your own spot, right? If you ever needed a loan for a car, a house, or rehab on a property, would you go to your bank or someone else's to do that? All right, you go to your bank to get those loans. And if you borrowed money from your bank, would you pay your bank back with principal and interest all day long? You would, right? You wouldn't steal from your bank. Just like how you wouldn't steal from any other business you may own or investments you might do. No one steals from themselves. So again, why don't all of you guys today have your own bank? I bet it's because it's something you haven't learned quite yet to do, or you've learned about it recently, but you're wanting to better understand this strategy so you can kind of get an overview of how you can incorporate it yourself. So let's get into it, guys. Let's dive into it today. I want to talk about today this literally 200-year-old strategy. It's been around for a very, very long time, and it's been used by the wealthiest families in history to eliminate their taxes, to pass money down to their kids and grandkids, and to build not just a rich lifestyle, but real generational wealth. And so that's what we're trying to accomplish big picture here, long term. And so those families who incorporated the strategy back in the day, they're people you probably already know. People like the Rothschilds. I'm sure you all know who the Rothschild family is. People like the Rockefellers. Man, were they impactful. Man, did they build a legacy. The Rockefeller family's still wealthy today. They knew what they were doing. You want to know how they built that wealth? Through this strategy. They became their own banks. Do you guys know Mr. Ray Kroc? You ever heard of that guy before? You know what business Ray Kroc started? McDonald's. You know how he started that business? Through this strategy. And more recently, Walt Disney. How did he start Disneyland when he was broke in the Great Depression? What were his options? Well, he actually started it from this strategy. And more recently, the football fans out in the room, Jim Harbaugh was the head coach of the University of Michigan a few years back. And when he got his final contract with them, he made sure his contract incorporated this strategy to make sure not just himself, but his kids and his grandkids were going to be well off forever. So this strategy, again, has been used for a very, very long time and more recently as well. So at least start with a little bit of confidence and give you some confidence in your speaker today. I'm sure a lot of you know who I am, just being a part of Chris Naugle's community. Some of you probably don't as well. So to share briefly about who I am and what I'm here to do today is show us some photos of us. This is my wife and I, our little baby, Mr. Wells. I live in Southern California. And over the past few years, I've met with over 3,000 families across the country, teaching them this wealth building concept. And this has allowed Anna and I to travel the world, buy a lot of real estate, got into some investing, and really build the perfect foundation to build generational wealth. And my story is pretty simple. I'm sure a lot of you can relate to it. I made a lot of mistakes when I was young, but when I was 18, I actually went and served a church mission. I served abroad for a year, and it was amazing. But when I came home and I was in school, I had a lot of outside influences pushing me different directions. And really, in one hand, I held the traditional route. I was going to be in the finance world, the finance program, go into that industry. And I was going through the motions to get that degree. And I was going to different networking events to start that world. And on the other hand, I was around real estate investors, entrepreneurs, business owners, investors. And I saw the freedom and control that they had in their life. And I came to a point in which I had to decide which route do I want to go? What direction do I want to take? Do I want to be a part of the so-called rat race, or do I want to learn how to make money work for me? And it was that tension, pulling these ideas apart, that brought me to a point of decision. And that decision was to actually drop out of school, the traditional school at least, and pursue an education in investing and learning how to make money work for me. And above all else in my path, that's what changed everything for me. And so really what I want to talk about today is the journey I went on and how I learned these things. As I was going through that, a question kept coming up that I felt like no one was addressing. And that question was, could it be possible that there are more efficient environments to store wealth outside of commercial banks that you are not aware of? So think about that for a second. The more you learn about money, the more you realize you don't know anything about money. At least that's what happened for me. It becomes a never-ending journey of financial education. There's always something new to learn. And so when I pose this question to you guys, really think about it. Are there better places to store money than what we're told? And it's a powerful question because I bet this is something you're not thinking about or haven't thought of before. And when it comes to money, we can have a humble and learner mentality throughout our life. And that kind of mentality really guides us to make the right financial decisions. I'm sure you've all read financial books like Rich Dad, Poor Dad, Money Master the Game by Tony Robbins, Richest Man in Babylon, those kind of books. What do all those books preach? They preach that you should be able to save at least 10% of your income. That's typically what people say. I hope most of you are able to save at least that. But in today's economy, the average American doesn't save nearly 4 or 5% of their income. They barely save it all, and it's simply not enough. In our American culture, we don't value savings. We don't value the retention of dollars within our control. And one of the reasons that I'm convinced that Americans are not saving enough money is because the environments or the places we're told to store this money are inefficient. These environments like savings accounts, high yield savings, 401ks, CDs, they're so inefficient that it makes it hard for us to want to save money in these places. So what we're going to dive into today is banking, a function called banking. I asked you guys in the very beginning if you wanted to become your own bank, how you would do that, right? So let's shift our mindset a little bit and start talking about banking as we dive into the environments we can store money, how we're going to do banking with it. And I want to start with kind of the definitions of what banking are. Well, really, what is banking? What's the definition? Well, it's the business of protecting money. That's literally the definition. It's protecting money. And why do we do banking with somebody else then if it's about protecting money? Who's going to protect your money better than you will, right? No one. You are going to use your money and protect your money more efficiently than anyone else. But that's it. I'm not. Bank's not. You are. So why are we banking with other people, right? And then what's the definition of banking in terms of the verb form, like the act of banking? It's protecting money, depositing money, and lending money. These are the act of banking. So wouldn't it be smart to learn a little bit more about this banking function in our life and how that actually applies to your finances? If every aspect of your life has to do with protecting your money, depositing money, or lending money, you're doing those things with somebody else always. So let's try and better understand it and find ways to control it ourselves. So again, through this presentation, I'm going to need you guys to kind of keep an open mind, because once you see the banking world and how it actually complements your life, you'll never be able to look at money the same way again, frankly. So what is your bank? Right? I said today that I was going to teach you how you can set up your own bank. Well, what is the bank we're going to set up? What this bank that it's going to replace your current account at someone else's bank, what's it going to be? So anytime you ever need to buy something, invest in something, pay off something, it would come from and go towards your bank. Again, not someone else's. So what are the attributes of the bank that you would like to have? If you had the option to choose to store money in a bank, well, it needs to be liquid, right? If your bank was liquid, a traditional bank, that's really all it is. It's just a liquid place to put money. And that's why people put money in liquid in savings accounts, because it's all just liquid. But if your bank was liquid too, then now it's equivalent, right? So we're now on the same page. Well, what other attributes would you want in your bank beyond just liquidity? For me, I want growth. If they can get some growth, that would be great. The traditional bank today earns 0.07%. If your bank was able to earn 2, 4, 5, 6, 7% uninterrupted and compounding forever, those are big words. That's powerful. That would be pretty awesome, right? What about taxes? I would love for our bank to be tax free. There's not many places the IRS lets us put money tax free. If we could find a tax free bank, I would do that. Taxable, that's not the move, right? We want it to be tax free. What about protected? If it was protected against lawsuits, judgments, liens, bankruptcy and divorce in some states, that would be pretty valuable. There's not many assets that do that. Your bank's totally unprotected. And last, stability. If your bank was going to be certain, stable in all economic times, that would be awesome. Guys, in 2009, 364 banks went bankrupt, meaning you could not touch your money. You could not get all your savings out. You could not pay for your life. That's a problem, right? Let's find a bank that's stable. And if there was a bank that had all of these attributes, wouldn't this be a much more efficient place to store money? This would be a place you could control, you could count on, you could use as the foundation to finance everything throughout your life. And we're always caught up in the chaos of our lives. So the opportunity that this would actually give you to put money somewhere that's still liquid, but also guaranteed, compounding, tax-free, completely risk-free, that should give you peace of mind more than anything else. That should give you the permission slip, the freedom pass to go do whatever else you want in your life because you know your money's safe. That's something everyone in this country should be diving deeper into is how can they build a place to put money that has these attributes? So guys, wouldn't you agree that if you could store your money in a place that did all of this, you would? Right? So let's get into what your bank actually is and how you can use it to do banking. I call the bank the vehicle we use, I guess a vehicle, because it's how you move your money. It's how your money runs through the system. And so all we're going to change in your entire financial life is one thing, not your investments, not your savings amount, not who you invest with, not where you live, not your age. None of those things matter. What we're going to use the vehicle for is just where you save your money. That's the only thing that's going to change. And so we're going to run our money through this vehicle and save our money here. And that's, again, the only change we're making in our financial life. And so what is this vehicle? The vehicle we use, I like to start with this quote. The problem in America isn't so much what people don't know. It's what people think they know that just ain't so. Guys, don't judge this that I'm about to share with you, because if you don't understand this yet, then you're going to make false, acquisitions and have false beliefs. The vehicle we use to do banking is none other than a dividend-paying whole life insurance policy from a mutual company. Boom, mic drop, fireworks, right? A whole life insurance policy? No way, maybe you're thinking. That's not liquid, that's not guaranteed, that's not growing, that's not a bank. Well, guess what? If you design it correctly, it is, and it's even better than what you're expecting. There was a question earlier in the chat of, do you use IULs or whole life? We use whole life insurance specifically. You could never use an IUL or any sort of indexed product to do banking. Those products are designed for other things. So we use whole life insurance specifically. And this is not the whole life insurance that your broke brother-in-law sells. You can't get it on the menu at State Farm. You can't just call Affleck and get this. Not at all. This is very specially designed and engineered. Has to be set up by the right people who know exactly what you're doing. And frankly, there's noise about whole life insurance all around the world. But I look at the policy in this way. I look at it like this analogy I'm going to share with you. If you guys ever go to a car dealership, you guys ever see a Ford Focus? This is a Ford Focus. Fine car, right? It's an okay picture, just whatever. It's a car. If you saw this car sitting in the dealership, you would think, well, it's a fine car, right? But if you look this car up on YouTube and you look up some racing episodes of people driving these cars, you can find a video of Ken Block, who's going. He's a baller racer. He's going 130 miles an hour, drifting around a turn in one of these bad boys, and he's crushing it. But the car looks like this. It is not the previous car. And what's the difference between that previous car and this one? Not much. It's the same vehicle. It's just the design and engineering of the vehicle is different. And so when we look at whole life insurance, it is totally different than any other life insurance you've ever seen. If we design these policies to do banking, it looks more like a supercharged bank account than anything else. And you now know probably something most people don't understand yet is that life insurance can be a valuable banking asset. But remember a few minutes ago when I said would you agree that if there was a place to store your money, put your money, that if there was a place that had all those attributes, you would, right? It's a great place to store money. Well, that's exactly what whole life is. You just haven't been told how it should be set up and how to use it correctly. And when I first learned about whole life insurance as a banking vehicle, I was skeptical too. I thought, no way life insurance is liquid. No, there's a huge cost to the insurance. There's so many fees built into it. I was told I had a low rate of return. I thought it was expensive. I was even told by someone it was the worst investment of all time. Now, that's a little much, but I got their point. And I thought to myself, whole life can't do this. It has a low rate of return. It's expensive. I thought these things too. And maybe you're thinking the same thing. Is this really what it is? So if you guys are taking notes today, write this down. Whole life insurance is not an investment. It's not at all. It has nothing to do with investing or investments. Whole life insurance is considered an alternative asset class and a type of permanent life insurance. If you actually read the contract, it says that everything is guaranteed and it's guaranteed to grow. So if you could take anything from today, take this. Whole life insurance is not an investment. And when you talk to your neighbor, your business partner, or your, again, broke brother-in-law who sells insurance, and you bring up this idea to them, and they start telling you, hey, don't do that whole life banking thing. The whole life policy is a terrible rate of return. It's got a low, it's a terrible investment. As soon as you hear someone say that, you now know that person has no idea on earth what they're talking about because they can't even correctly identify what type of asset that it is. So guys, don't trust random people off the street. Trust banking professionals who teach the strategy. You can only get policies like this from those banking professionals, companies like ours. So again, listen to people who know what they're doing. And this strategy came around, again, like I said, 200 years ago. People were using whole life as a bank forever. This book right here, Becoming Your Own Bank by Nelson Nash, he highlights this throughout his entire book, teaching this strategy. He studied business owners. He studied wealthy families, and he realized what they were doing. And he wrote this book on this strategy and shared it with everybody so everyone can incorporate the same ideas. And in this book, he highlights a couple things. He says that the problem is that you finance everything in life. And maybe you're thinking, what on earth does that mean? Well, it means that you either borrow money and pay interest to somebody else, so you're financing something, or you save up money and then use your money and spend it on that thing. But now you give up the interest that you could have earned on that money forever. I'll give you an example. If you bought a car for 20 grand, you saved up the cash and you think you're doing the better thing by paying cash for the car. Well, guess what? There's still an interest cost. You just paid 20 grand for a car. What's the interest cost, you might be asking or thinking? Well, imagine that $20,000 sitting in the S&P for the next 30 years. That would probably turn into hundreds of thousands of dollars. You're losing that growth because you're spending it. So there's an interest cost to everything you do. And the problem is that you do this banking and this financing with other banks. So they're making those profits. But what if you were the one banking? You were the one financing, you were the one lending, you were the one taking loans from all your own bank. Then it doesn't matter. Now you're in control, you're the bank, and this problem disappears. This is why you need to become the bank. So you can be in control of all those transactions. So you can be the one in the center of it, controlling, collecting, and making insane profits off of all the hard work you're doing. Again, we're looking at banking, not an investment. The policy is not an investment. An IUL is an investment. You're investing in the market. So if we're looking at a banking vehicle, we want all guarantees built into this. We want what's been tested and proven and what works. We don't want investments as our banking vehicle or as our foundation, as our savings vehicle. We don't want that risk. So who else does this? I mentioned some families before, but also banks do. You can look boldly up bank-owned life insurance. Just these 4 banks alone, the 4 biggest banks, have over $60 billion of whole life their own. Guys, what you'll find if you look boldly up, if you look up these banks and such and find their reports, you'll see that they own more whole life insurance. Whole life, not IULs, not term insurance, not VULs. They own whole life. And they own more whole life than they own in land and buildings combined. Guys, banks are actually the #1 purchasers of whole life insurance in the world. Not only do they own more whole life, they keep buying more every single year. So you need to ask yourself the question, are banks stupid or do they just know something that I don't know? Right? Guys, they're not stupid. They're very, very smart. They know what they're doing. We just need to mimic them, right? Let's just mimic what banks do. So what do banks do? Well, let's talk about it. Let's show you what banks do. If you deposited money in a bank, let's say you had 100 grand to deposit, and that 100 grand was going to earn 4% at the bank because you have a fantastic bank, right? Let's just say they're making 4%. What's the bank going to do immediately when they get your 100K? And again, we can use 10 grand, $1,000, $100, you pick the number. That bank then immediately goes and lends it out. They lend it to somebody buying a house at 7%. So they're making a spread off your money. And then what does the seller do when they get the money after the close? Well, they put it back in the bank, right? Wait, so does that mean the bank just took your money, gave it to somebody else at 7%, and then they just got it right back immediately? Yeah. And they're still making profit. That's a pretty cool business model, right? And then what if they lent it to somebody else, that same money to someone buying a car at 8%, who then paid their car dealership, who put the money back where? Who then probably is going to pay for lend it to somebody else on a home remodel loan, who's going to pay a contractor, and where's the contractor going to put their money? They'll probably lend it to somebody else on another loan at 12%. They'll pay their credit cards off and then put the money back again. So, guys, the banks are making money the whole time. They're making 3% on that spread. They're making 4% on this spread. They're making 9 or 5% on this spread and 8% on this spread. If you count all of that up, they're making 20% more than you on your 4%. And if you do the math, how many times does 4% go into 20%? 5. So doesn't that mean that they're not making 16% more than you are or 20% more than you are? They're making 500% more than you are on your money every single year. And I'm not making this crap up. If you go to BauerFinancial.com, you will find that banks make between 400 and 1300% on the money that you leave there every single year. Guys, there isn't a bank in the country making less than 400% on your money. So earlier when I told you guys that these banks are the number one purchasers of these specially designed policies, the thing I asked you was, are banks stupid or did they just know something that I don't know? You probably should know. Banks are not stupid. They know something we don't know. So in order to understand what this is, you need to understand a couple more things before I give you some real life examples. Have you guys ever heard the riddle before? Would you rather have $1 million today or a penny today, but that penny doubles every day for 30 days? So what would you guys want? I assume the penny, right? Well, here's the math behind that. A penny that doubled every day for 30 days would turn into $5.3 million. Boom, right? That's a ton of money. And let's stop here for a second and appreciate the power of compound interest here. A penny goes to 2, 2 to 4, 4 to 8, 8 to 16, and so on and so forth to 5 million. Didn't Einstein say that the uninterrupted compounding interest is the eighth wonder of the world? This is why. This is pretty cool. So let's change it up and talk about compounding here in some other scenarios. What if there was a fee attached to this compounding? Just a simple 2% fee. And I'm sure you guys have plenty of places you've put your money where there was a fee attached to where it was, where it was sitting, any sort of money market account or money managed account of any sort. Well, with that 2% hit going against your compounding, it would only compound to about 3 million after 30 days, which is still better than the million, but not as good as the 5.3 you could have gotten. And is a 2% fee really worth, what is that, 5.3 minus 3? It's a $2 million spread that you're losing on because of the fee of 2%. Like, that is a huge deal. That is a ton that you are missing out on. What if instead of a fee, there was a withdrawal? What if you withdrew $100 on the 15th day and $100 on the 25th day from this penny that's compounding? So you only took out $200. $200 withdrawals over the full 30 days. That $200 of withdrawals would have cost over $3 million of compounding losses. Because again, this could have been 5.3, but now it's only 2. So that $200 withdrawal would have cost $3 million in compounding losses. That is a whole lot more than $200. That is a problem, right? Let's do it one more time, but with a tax. What if you were taxed on the gains every year? The account would, or not the account, the penny would only double to 500K. So I highlight all of this to put into picture how important it is to have a place to put money that does not have these things going against you. And to put it into perspective that money that sat compounding uninterrupted would be, I can't even state it, amazing. And how many of you would agree that some of the places that we've been taught to put money have all 3 of those things going on inside of them? I'll give you an example. A 401k. There's a small fee for somebody managing it. It's going to be taxed in the future. And you can tap into the money whenever you want if you wanted to withdraw from it. You could. You also could take a loan against it, which is what we typically would recommend. But you could take withdrawals. And we wonder why we can't get ahead and why Americans suck at saving and growing their money. Guys, uninterrupted compounding interest can be so efficient and so powerful if you just let the money sit there and do its thing. But who would actually let you do that? Where is there an account that has no taxes, no percent fee, no management cost, and no withdrawals? You guys probably know the answer now. These specially designed whole life insurance policies. Your dollars sit and compound always. Geez, right? Did you know the policy could do that? So now that we've laid the framework of how powerful whole life insurance is, the credibility behind it, what banks do and how they operate, and then why you'd want to become your own bank, and now compounding interest, let's go put this puppy in action. Let's show you how you actually can do this, right? So I'm going to give you an example of buying a car. Let's say this is the car you wanted to buy. How could we do that with a policy? How could we be the bank on this purchase? Well, I'm going to show you that, but before I do, let's go through a couple items that we need to discuss. If you're looking at a policy as a premium you pay into it, a lot of people when they hear the word premium, they think that is a expense, that is a cost, that is a fee, and most people look at life insurance as another bill. We want to change your mindset around that. Sure, regular term insurance, that's a bill, yes. But this whole life policy, if it's liquid, it's growing, it's now a deposit into a savings vehicle. So we're no longer thinking, oh, I want the smallest expense, the smallest premium. We're now thinking, I want the biggest deposit. I want to save as much as I can in this vehicle. That's the change of mindset that needs to happen. And you might be thinking too, well, actually, before I say that, the other thing that people talk about is their age. People might say, hey, I'm too old to do this. I've had someone, literally, this is ridiculous. Someone who's 45 saying, I'm too old to do this. Guys, that is so young. You're not too old to do this until you're uninsurable, until you're in your 80s. So guys, your age does not matter. If I was to put $1 into my whole life policy that was built for banking, and my grandmother put $100 into a policy for her, it's still $100. It's still $100 earning the same dividend rate, the same liquidity, the same banking needs. The only difference is how much death benefit that policy buys. So the third point's death benefit. We are not here to build a policy to give you the biggest death benefit. That's regular life insurance. We are here to build a banking system. The death benefit is just a side effect of having the policy. We're going to actually minimize that death benefit and maximize the cash value so we can use the policy again to do banking. So age is not important. Death benefits do not matter. And premiums are a deposit. So now that framework's kind of set in place, let's dive into this. So I'm going to show you an example of paying premiums every year into a policy. Again, we call it deposits. Your cash value in the policy over there on the right, that's what's available to use. And then let's show you taking a loan from your policy to go buy a car. So let's say this, you were saving 10 grand a year. You made 100K, you save 10% of your income, that's 10 grand a year. And you want to save that 10 grand a year into your policy. So you're putting 10 grand away every year, making it easy. And then the cash value is growing and available for you to access. Let's say in the third year of you having a policy, you want to go buy a car. So in year number 3, you take $25,000 out of your cash value as a loan. You go buy that car. And then if you're going to take a loan against your policy to go buy a car, you should pay yourself back, right? So what's a typical car loan today? $25,000 loan, maybe that's $500 a month for 60 months. So if that was the case, that's $6 grand a year. Let's just pay ourselves back what we would have been paying somebody else. So in this scenario, if you were able to save 10 grand a year, you wanted to go buy a car and you paid yourself back what you would have paid the bank, here's what that would have looked like over a 7-year period, just to give you a little snapshot. 7 years into this system, you would have paid $70K in total premiums into this life insurance policy. You would have taken $25,000 out as a loan. And then you would have paid $30K back to yourself as you're paying yourself back as if you were the bank. That means you deposited $100K into this, but you took $25 out to buy a car. So your net injection into this policy is $75,000. So you've put $75 into it, and look at your cash value. The cash value is $67, which means you have access to 91% of your money that you've put into this. Or in other words, you got 91% back on the car you just purchased. Does that click for you guys? Does that make sense? The math behind that? And the reason this is the case is because all of those deposits in your policy over this time frame are growing. It's earning an interest rate instead of the policy. And so over time, it's just building while you're purchasing this. I'll give you another example. Let's say 8 years into the policy now. You're at a point in life where you're thinking, I don't want to deposit any more into this. I've saved enough. I'm retired now. I can't save. Let's do no more contributions. Well, if that was the case, that's okay. Let's stop contributing towards the policy. But maybe you need another car. So let's take another $25,000 loan against the policy to go buy a new car. And then, what if you paid the car back $500 a month or paid your policy back $500 a month like, you were the bank? Well, if this was a scenario, again, you would have done no contributions, but you would have paid $30K back to your policy. So $30K out of pocket. but you would have taken 25 out to buy a car, which means your total injection in those 5 years was 5K. And what did your cash value increase by during that time? It grew from 67 to 91, meaning your cash value grew by $23,000 and you put in five. So your money 4x'd, almost 5x'd in those years, and you bought a car. Look over the whole time frame. Over the whole 12-year period, you put in 75 in the first few years, you put in 5K in the last few years. So you put in 80K into this thing, and your cash value is 91. So you made money on your investment and you bought two cars. Now that is some crazy math. That's pretty powerful. And there's three rules we incorporate when we do this. Rule number one is pay yourself first. If you are not going to save money every year, then there's no point of doing any of this. You got to save money and pay yourself first. Rule two, you got to pay yourself back. If you're taking loans from yourself, you can't steal from your bank. You got to pay the bank back. And third, if you're going to pay yourself back, wouldn't you want to pay the interest back to you as well and recycle and recapture that interest? Of course you would. So those are the three rules we want to incorporate when doing this. And if this works for a car, what else does this work for, guys? Literally anything you do. Guys, who wish you knew this earlier in your life? Don't you wish you did this last time you purchased a car? Who's going to do this the next time you purchase a car? What about the next rental you purchase? What about the next time you pay Uncle Sam taxes? What about next time you, I don't know, pay for a kid's tuition at school? All of these financing transactions you can just do with yourself if you just become the bank. So first off, you need to pay yourself first. You need to save money. If you can't save money, none of this makes sense. So save money, guys. Rule number one, if you save money and you're now looking to finance things in your life, take loans from yourself and pay yourself back with interest like anybody else. So again, be the bank. So another way to look at this, and sometimes people like this better, is another kind of diagram to better understand taking a loan against your policy. So I'll give you an example of someone who had a line of credit they were trying to pay off. They had a $23,000 line of credit that they owed 9% on. And so we said, okay, great. How about instead of taking your 23K in cash and paying off the line of credit, because then you're losing the 23K, let's put that in your policy. And then let's take a $23,000 loan from your policy and pay off your line of credit. Basically, now you just refinanced your line of credit with yourself. And if that line of credit payment was $289 a month, call it $300. Well, if you were going to pay $300 a month to someone else's bank, why don't you just pay yourself back $300 too? Just do the same thing. And if that $300 included that 9% interest, then yeah, let's just basically pay ourselves back 9% with $300 a month. So it's really just a circle, guys. Your money starts here on the left, and then it goes to work for you on the right, and then that money comes back as you pay stuff off and recycle the money. So you're making money multiple times on this transaction. You're paying yourself back at a higher interest rate, and you're making money in the policy, and you have a death benefit while you do all of it. And so you are now the one compounding on your money. You're the one making interest at all times. The bank is not doing so. You are. And so this is what we mean by just being the bank. If this was not a debt, if this was an investment instead, let's say you invested in PMC and they were going to pay you 12%. Well, now that income you're receiving, you can put back in the policy, and now it's even better. So guys, throughout our life, two things are going to happen to us. One, we're going to be alive. Obviously, you all here today are alive. And two, we're all going to pass away. It's guaranteed, right? As sad as it is, we're all guaranteed to pass away. And I just now showed you, you are much better with this than without while you were alive. And what do you think now? Well, are you better, or is your family better off with this than without? 1,000% it's better. There is a death benefit attached to this policy that I, again, don't want you guys to forget. So when you pass away, your family's going to get a multiple, a massive multiple of what you've put into this. So now you're not just setting yourself up to be the bank. You're now setting up your kids and grandkids to be the bank for their families. Guys, don't you wish you learned this when you were my age? Don't you wish you learned this when you were young adults? Don't you wish your parents started your family bank for you? There's tons of details. Like, how do we set up the policy? Who qualifies for this? How much should I put into it? When I take loans against my policy, how should I pay it back? All those questions are fantastic. And I could go through those today, but it's very personal. Everyone uses their system differently. You might have debt you want to pay off. Joe Schmo might have cars he wants to buy. Susan might want to buy real estate. So everyone's going to use their policy differently, which means everyone's going to set them up differently. Everyone's going to use them differently. And so really, the solution for you is working with our team to figure that out. We are an infinite banking company where we show people how to set up these policies, where to get them set up, and then give them a set plan of how to use it. There's no cost or fees to work with us because we're paid from the insurance company. So it's really just you setting up and using a policy to do banking, and we're here to make sure you set it up right. So all those little details of how you can do this, we can solve all those details in a personalized call one-on-one with you. So to wrap up today, what we talked about was three things. We showed you how banks profit by leveraging your money. So let's just flip that script and be our own banks. And then showed you how you don't need to be rich. Anyone can do this. You just need the right tools and the right team to help you. And with inflation, market uncertainty, the economy the way it is, family banking gives you the total financial control. If you want to have certainty and control over your money throughout your life from here on out, then you absolutely need to set up a banking policy. There is not an if, and, or but in that. So again, guys, of course, there's so many details we need to get into, and I will leave some time here for Q&A. But we need to show you how you can incorporate this on your own, and that's really the solution. It's not on this Zoom. It's a one-on-one meeting. So how do we get that set up? Please schedule time to book with me on my personal calendar. I'm actually headed out this week, so I don't think there's a ton of slots available in the next couple days. There might be though, but that link, I just put it in the chat. Just go to carson.beyourownbanker.com. Please go there, set up time to meet. And on that one-on-one meeting, I will meet with you and go through your finances, your goals, your plans, and help you build a personal system so you can be the bank that you want to be. If you want this recording sent to you, it will be replayed and sent out. And if you go to Chris Naugle's YouTube, it'll be replayed on his YouTube any day. Any day now. It always is. So if you want this to be sent out to your family, your cousins, your friends who you think can incorporate this strategy as well and should learn this, please send it out to them. This message needs to be preached, needs to be shared. It will change your life as it has mine and thousands of our clients. And again, everything we do is free. We're paid from insurance companies. So there's literally no cost for you to do this. They pay us for the business that we bring them. So the goal is to set up your banking policy and give you a step-by-step plan of how to incorporate it. That being said, guys, that's all I got today. Appreciate all of you being here today. Happy Tuesday, and I'll see you on the next one.